For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. All right, what do you say let's do it, huh? Let's manage your financial future, at least as best we can. Podcast host Johnny Dean here with you, along with the certified financial planner professional, Rick, the Professor Plum.
You had to look at the cheat sheet to remember my name?
No, I had to look to make sure I wasn't CFP professional. It's both. Now, I think I got your name down by now.
Yeah, 30 years together.
At least, yeah. Accredited wealth management advisor as well. Welcome, Rick. Thanks for being here. Yeah.
I'm wondering now.
Yeah, I don't know either. We're going to see where this goes. We had a topic, I don't know. I think it was back in April. I can't remember. But it was a few months back, and we talked about something called blending buckets. Now, I mean, we're not really going to talk about that now, but we're going to talk about a subset of that or an offshoot of it. We had some people asking us about that particular program. Yeah, I was it technical? I don't remember if were we too technical on that show?
We got real technical on one show, but I don't think it was that one.
I don't remember, but there were more questions on that one, and so what I thought I would do was follow up a little bit on this.
You're not.
We've got personal money, we've got Roth money, and we've got, let's say,
tax-deferred money.
Yeah, IRA type stuff, right? Those are pretty much the 3 accounts that you have.
3 big categories. There's some subcategories off the chutes.
Right, so I'm going to leave that alone. But those 3 types, the question is, when you're in the withdrawal stage of your life, let's say retirement, where do you draw from? Because there's a lot of confusion from people, especially if you read online and you try to ask, well, which one should I've got? I've got this. I've got Roth, which, let's pretend it's all qualified to take it out tax-free.
Yeah, we're over 59 and a half and at least 5 years in the Roth.
Yes, we've satisfied those. So our Roth funds are
totally available, tax-free.
Tax-free. But I've also got, IRAs or 401ks or pre-tax money. Now, I can take money out of that account, but it's taxable.
Right.
And I don't like paying taxes.
Who does?
But then you've got the other kind. You got the personal accounts. These are things like brokerage accounts. Your
personal accounts are interesting because I can kind of control the taxation to an extent with my IRA because I can choose to or not, with ignoring RMDs at the moment, take money out of my IRA, and I don't pay taxes on it until I take money out of the IRA. Now, I'm using the IRA as kind of a catch-all for all retirement plans, 401ks, 457s, profit-sharing plans.
Yes.
So IRA is just my catch-all for that. The tax-deferred retirement plans. If I don't take any money out of it, I don't pay any taxes. My Roth IRA, I can take money out of it, and it'll be, in our example, tax-free because we've met all the requirements. But I kind of like the idea of letting that grow for the future, too, so that I can have it when I might need it, when I might have other taxes to pay, and I don't want to pay. If I need a new car, I need a chunk of change quick, and I don't want to have to take it out of my IRA and jack my tax bracket because it's a bigger than normal distribution. But the personal money, the taxability of the personal money is an unknown to some extent because I'm investing it, and I'm taxed on whatever that earns as it's either being earned in the form of dividends or interest, or as it's what they call realized in the form of capital gains. And there are times where I have large capital gains. I'm not taking any money out of it to live. I'm leaving it alone. I'm reinvesting. It's a mutual fund. It's a growth. And I've got to pay taxes on this stuff, even though I didn't use any of the money to live. And so the personal account is the large unknown.
From a tax standpoint.
But we have to make certain assumptions on what it may or may not do. And it's interesting with the personal money, assuming you're using mutual funds that you have very little control over, we see a lot of times where the bigger taxabilities, the larger capital gain distributions, happen during downtimes. It's like in 2022, the market was down, and
because they're panic selling or because they need the money.
Well, the mutual fund itself is selling shares that the mutual fund owns.
Oh, I see what you mean. Okay.
And when they sell shares, they create hopefully a gain.
You're talking about the once a year.
The capital gain distribution at the end of the year for anybody who stayed into it for the year. So it's a little difficult. So if you've got, like $500,000 in Roth, $500,000 in traditional IRA, $500,000 in personal money.
That's pretty good. That's a pretty good portfolio.
$1.5 million. Yeah. We know what the taxation is going to be when we take money out of the IRA. We know what we're going to, with the taxation or not taxation on the distribution of the Roth, but we don't know exactly until it's over what the taxation on the personal account is, whether we take money out of it to live or not.
Yeah, and
it's a little wild card.
Well, it is, and this is why people get confused, and this is where I think it's helpful to have somebody advising you in this particular instance, because when you're trying to decide, first of all, I need the money, I know that, but I don't want to mess myself up terribly from a tax standpoint.
Right.
And sometimes, as you've said in the past, Professor Plum, it's better to pay maybe a little bit of tax now, potentially.
Quite a few times it's better to pay a little tax now than to let it defer until we have to take it out, either because we have required minimum distributions and we're getting older, or our heirs have to take it out because we're dead.
But at the same time, you say, well, I don't want to take too much out of the tax. I don't want to pay too much because...
that $500,000 traditional IRA I mentioned a minute ago,
yeah,
taking it all out at one lump sum would be very ill-advised from a tax standpoint.
Well, yeah, and depending on each person's situation, if they take out just enough, it may push their Social Security, if they're receiving their benefits, push that into the taxable column.
All of these issues come into consideration when you're creating an appropriate, efficient drawdown strategy for a tax purpose. We talk about buckets. Buckets gives us the investment allocation of the types of investments we should have. How much should we have in safe, secure, drawdown money for bucket number one, moderate money for bucket two, long-term money for bucket three. But the next step is to determine which accounts, the asset location, which accounts do I have in bucket number one? Is bucket number one all IRA, or is it all personal money, or is it all Roth money, or is it, as we started off talking about, blending a little bit of more than one of those accounts, maybe some of two accounts.
Yeah.
And all of these things come into consideration when we're talking about how to create an efficient distribution on your drawdown.
Well, as you're talking about this, I say no wonder people were maybe asking us after that show aired. I'm a little confused here. Well, I don't know what to do with this.
And then you have to layer in the tax brackets. But the tax brackets are fairly easy to understand if you understand certain terminologies within taxes. What is your taxable income? But if you are, so I actually did a training course on this a couple of weeks ago now, and people are asking me, advisors said, show us what you look for when you start thinking about conversions or blending money. And the first thing I'm going to look at is last year's tax return, assuming that they're pretty stable from year to year. We're retired now. The Social Security is what it is. Pension is what it is. And the spending, they know about what it is. What was last year's taxable income? What tax bracket are we in? The next thing I'm going to look at is how much of the Social Security that you're receiving is being taxed. Are you at a position where you're just getting into the thick of it and it's going to hurt? Or is your income high enough where, hey, your Social Security is going to be taxable no matter what you do?
So nothing you do is going to increase that. You're already paying the most.
Because if I'm already taxed on my Social Security because of my pension and other things, now I'm into true tax brackets where I know exactly what that next dollar of income is going to cost me because I know what bracket I'm going to be in. If I'm not fully taxed, meaning up to the 85% of my benefit being taxed level of Social Security, now I've got to go back and say, well, yeah, I'm in the 12% bracket, but it's really costing me 22 cents for every dollar I take out of my IRA. So do I want to blend this now? Or do I want to wait till later? And so all of these things come into play.
Well, if somebody comes to you and they say, let's just use your example, they got a lot of money. They got $500,000 personal, $500,000 Roth, $500,000 IRA.
So they're poverty level in Southern California. Well, they're below poverty in the Silicon Valley.
It may very well be, but they've got this money, and they say, look, I heard you talking, Professor Plum, about this. How in the world do I begin to decide what goes into my bucket one? In other words, what do I spend first? So what are you going to talk about?
We know how much goes into bucket number one. The question is how much of bucket number one do we put in the IRA versus the Roth IRA versus draw from personal.
So you started to do this. What would you ask me in order to help me determine this? Because I've come to ask you, which one should I spend first?
Let's take a look at everything you're receiving that you don't have control over. What's your pension?
Yeah.
What's your Social Security? Your spouse's Social Security? Your spouse's pension? Do you have rental properties? Do you have rental? Where's your income coming from that is basically set? And then how much more are we going to need to be able to how much do we have to withdraw from the portfolio to be able to live?
Okay.
And then where are we going to create the efficiencies? That's where we start looking at the tax brackets. We start looking at the taxability of the Social Security. We start looking at, are we bumping our heads into the net investment income tax, which is a little bit higher? Are we bumping our heads into the IRMA, income related monthly adjustment amount? Let's get a look at where we are before we start taking money out of the IRA, out of the Roth, out of the personal account. As I said, though, we have to make assumptions about the personal account. What's it going to earn? How is it invested? And for somebody with a portfolio, like I described earlier, I would try to stay a little bit away from mutual funds just because we have less control over them. I would like to use ETFs where we have better control over the taxation and or individually managed portfolio, individual stock portfolios.
Exchange traded funds.
ETF, exchange traded fund. They don't have the capital gain distributions. They don't, if the market goes down and people want to sell them, they're not redeeming their shares back with the issuing mutual fund company. They're selling them to somebody who thinks the market's going to go up. They're selling on the secondary market, not the primary.
Well,
so it's just understanding.
So you've asked what you're doing to determine which I should take out first is you're asking me what other income I have right now. Do I have any rentals? No, maybe not. All right. Do I have Social Security?
Let's paint a picture pensions? Of where's your baseline?
Yeah.
Where are we starting from a tax standpoint when we draw money out of your investment portfolio? And let's see, can we do this efficiently? And also, first off, how old are you?
Yeah.
How long before we have required minimum distributions? Are you in required minimum distributions? We have to make sure that we play with that idea that, okay, we can go very low on taxes right now, maybe by not taking any money out of the traditional IRA type tax deferred accounts. But what happens 8 years from maybe you're retiring at 65 and
let's say I'm 65.
And 8 years from now, you have a required minimum distribution kicking in. And so now you're going to shoot yourself in the foot with taxes because your RMD is going to be quite a bit larger because you've left the IRA alone for 8 years. Maybe we want to take some out now. So we've got to know where we are first.
All right.
And then we start saying, okay, we have this much more room in X bracket, or we have this much more room before we trip into some other little landmine.
Yeah.
Now, this does require us to understand the difference between gross income and taxable income.
Yes.
And so there are some semantics in here because a lot of people look at it and say, well, my Social Security is X and my IRA distribution is Y and I've got this much of pension. So my income is $100,000. And if I look at the brackets that you go online, you say, tax brackets for this year. Well, the top for a married couple filing a joint return, the top of the 12% bracket is $94,000 and change. Well, that means that I'm in the 22% bracket, right? No. Because not all of your income is taxable.
So you have to have an understanding of the tax
Bit.
brackets. But this becomes so confusing, Professor Plum, as to how I determine which one.
That's why you talk to somebody who it's not confusing to.
That's what I'm saying. It would be a horribly daunting task to me to try to figure out the answer to this question: which one do I take out first, Roth, personal, or IRA? Because obviously everybody's situation is different. But what you're looking at, really, is this purely a tax play here? Is this really what we're trying to tax efficiency over the long haul?
Over the long haul. And the long haul includes, especially for a married couple, it's not just what's best today. Well, there are two people alive, but what happens when there's only one person, a survivor? Because their brackets, although they still have currently the 12, 22, 24 and up.
Yeah.
The amount of income we can have in those brackets basically gets cut in half. So the single individual has a much higher tax bill for similar income than a married couple. Yeah. And so we're looking at that as well, as far as survivor planning.
Is there a general rule of thumb, though, that would apply to?
General rule is, if possible. Now, the wild card here is Roth, because that can do anything.
Yeah.
Because it's tax-free.
Yes.
So it can go, but the unfortunate issue with most people with a Roth IRA is it is a relatively small percentage of the overall. It's not 500, 500, 500 like I described earlier.
No, you would have had to done a lot of
conversions, 200 and 100 or so of Roth. So it's not enough to make a big difference in a lot of people's lives. So that will throw the Roth. But the distribution from a traditional IRA is going to be ordinary income. So if I'm going to be taking interest, if I'm going to be earning interest, I'd rather earn the interest in the IRA because interest is taxable as ordinary income. The distribution from the IRA is ordinary income. Now, these are not hard, cold, fast rules of thumb. These are considerations. On the other hand, capital gains, long-term capital gains, qualified dividends, things from stocks give us a preferential lower tax bracket. So
the capital gains
capital gains rate, long-term capital gains rate, is lower than the ordinary income rate. And I get a step up in basis if I happen to die and leave it to my spouse or my heirs.
Yeah.
So as a lean to, I'm going to lean towards putting the personal money into growth, tax-sensitive growth investments, not tax-deferred. And I'm going to lean towards putting the IRAs in the ordinary income-producing assets.
Because they're ordinary income
Because
anyway.
when they distribute the money, it's going to be ordinary income anyway. Those are not rules. Those are my lean-tos. Those are what I'm going to look to. That's my bias. I'm going to try to go that way with it. But if I have money in, $200,000 in a CD or a treasury, and we have to, play with the fact that treasuries are state tax-free depending upon what state you live in.
Yeah.
I was actually looking at treasuries the other day for a client, and the difference between treasuries and CDs that we could get. The 6-month and the 12-month, the difference in rates from the CD to the treasury were not enough to warrant buying the CD. The CD was a little bit higher, but not enough because these people were in the California income tax bracket to warrant buying the CD.
Because it's taxable, the CD is taxable at the state level.
10% basically, where it wasn't. So there wasn't as big enough jump. But the 18-month and the 24-month, there was a pretty good sized gap. And so that even after paying the California income tax rate, you still had more money in your pocket than the Treasury allowed. And so those are things we kind of look at.
It's funny when people are listening to this podcast and they said, "Oh, okay, so Roth personal IRA, which should you take out of?" You know what they're going to do is they're going to tell me. They're going to say, "Well, you should probably take it out of your personal first, and then you should take it out of your Roth."
That's what the internet mostly says,
right? And
although it's nice to see that there's some big companies out there. The big brokerage firms that are now starting to say, you know what, blending can make some sense.
I was very surprised to see this because I asked this very question: what should you take out first?
You asked the internet that?
And I purposely went to this very large, green line company that said, in the past, it was often advised that you hold off. You
never touch the conventional wisdom has been. Leave the IRAs alone until you're required, and then only take the RMD off. Live on your personal money. Give yourself as low of a tax bracket today as you possibly can.
And put off taxes until much, much later.
And the Roth never gets spent in your lifetime.
Well, yeah.
That's what they say.
They kind of said that. So they said, you're going to pay no taxes now, but you're going to have a much bigger. And I was surprised to see that because it's one of the few times that I've seen.
Well, now that they're saying blending it can make some sense.
Yes, because they actually worked the numbers and said you actually, in their example, and I don't have it here with me, but they wound up paying quite a bit less in taxes when you spread the tax bill out over time.
Oh, yeah.
Over 30 years. Or I think they used 24 years, whatever. But it was a far better thing. And
far, far better thing we do.
Than we have ever done before. I don't even know where that came from. But it is. And, for somebody who's looking for a pat answer.
Right.
Tuning into this podcast because when you...
Well, there is no pat answer. I mean, you joke and you tease me about
I do all the time.
My pat answer is, it depends.
Yeah.
That's my go-to answer because in pretty much everything we're dealing with the exception of somebody who's 70 and a half or older that wants to make charitable contributions to a QCD. Other than that, my answer is, it depends.
Yeah. There's nothing that says everybody who's doing this should do
one way or the other.
Yeah.
And it's different. And even people with the same amount of total income, like the person, $100,000 of household income, how the income is structured is dramatic and different with taxes. Maybe they had $60,000 of Social Security and $40,000 of other income versus somebody who is got $20,000 of Social Security and $80,000 of other income. Total income is still $80,000 or $100,000, but the taxes are a lot different.
Boy, I mean, that's an extreme example, but that's you need to say that to show it, to illustrate it, and that's
Right.
a very good example.
And
Now,
it's not as uncommon as you think, because we do have people that have pensions from government service and other things where they
Sure.
did not pay, and they're married to a spouse that has Social Security, and so they've got some Social Security, $25,000, $25,000, and they've got a good sized pension on their own. So between the two of them, they've got pretty good income. But we can say almost for a fact at that level that I talked about, 20 and 80 of pension, 85% of that person's Social Security is taxable. So they've got quite a large amount of the 100,000 to be taxable. Whereas with the 60 and 40, they may be only having 30,000 of their Social Security be taxable. 30,000 is going to be tax free.
Now, when you see people, I know you don't really see people doing it on their own because they've come to you. But if you've ever seen somebody who has done it on their own.
Well, we see people that have done that on their own when they come to us the first time and say, this is what I've been doing. And we say, interesting.
Well,
okay.
Well, but that's okay. That's why you come to the advisor.
We've seen it.
But you see that happen, and is it more likely that they've just decided to not take their taxable money now, that the psyche won't let them pay taxes now as long as they can push it off to a later date?
To some degree, yeah. There are some people who are just so adamant against taxes that they will do whatever it takes to reduce the taxes right now, and tomorrow be darned.
Well, and maybe they're hoping that things will change in the future, that tax brackets will go down. I don't think they're looking ahead.
The people that I know that are in that kind of, they have money.
Yeah.
And they're in a situation where it's not going to change for them in the positive in the future. The tax rates are not going to go down for somebody in those categories that have the ability to defer and take. Most people are spending the money they have because they have to spend the money they want. I mean,
what considerations do you have for somebody who's got Roth personal or IRA, but let's say in their personal account, they've got a lot of
capital gain already,
capital gain in there built in, right? So if anything they sell is going to create a very large capital gain. Where does that play a role?
Well, we look at where we are. Should we be taking money out of the IRA? Assuming the RMD has either been met or we don't have one right now, the question is, should we be selling some of those securities because you feel that they are not, you don't want to lose what you've already got. Remember, once I have capital gains built into my investment, I've got those paper gains.
Not that we mentioned individual stocks, but
I exaggerated it.
I mean, I understand. I get it.
That's on paper. I don't have to pay anything for it. And thankfully, the Fed backs me up on this. They went against the global thing.
Yes.
But when I sell them, I have a capital gain. If I'm worried about that particular individual stock going down and I want to sell it, how do I create room in my bracket to be able to sell it at that preferential treatment? So I may take less out of my IRA so that I could sell off some of my capital gains so that I can lessen the risk. This is a risk issue. So the first thing we're looking for is, should I be selling some of the securities I have because I'm overweighted in one of them and I don't want the risk. So now I need to sell it. Now we look at, okay, you need to sell some of that, or you want to. How do we do that in a tax efficient manner? Do we lessen up over here? And so now we're building that into the overall portfolio. Or I know somebody out of the state of Washington who bought $30,000 worth of Starbucks, like in 1800 or something, when it first came out. And, and they're never going to sell their Starbucks while they're alive.
No?
Never. Because I think they got $12 million of gain.
Oh, I get that. So they own it personally.
They own it. Oh, yeah. We're always talking about personal with this because that's the only time the capital gain tax applies.
Yes.
But it's a matter of, let's look at the overall portfolio. Should we be thinking about lessening up some of the personal growth area that maybe you've got all of your personal money invested for growth? And reality is you should have some of that in more safe or different investments. How do we start lessening that without creating a big tax bill? That's where we have to watch out for IRMA a lot of times.
Well, yeah, and you are correct. And people don't. I don't know that people often think of this because maybe they've done that in their 401k where they said, well, yeah, let's pair off these.
Right. It's easy to do inside of an IRA, Roth IRA, or
there's
401k.
No tax.
No immediate taxation unless I take a distribution of the money.
Right. But as long as you do it all within the 401k or
and
the
that's
IRA.
the benefit of a tax-deferred retirement account.
You could have a huge gain in there that you sell and you keep it in.
Until I take money out, it doesn't hurt me.
But that's where the personal money...
And personal money we have to build into the overall plan and look at where we are. And so maybe somebody who's been doing conversions along the way doesn't do a conversion this year. They use that space in their tax bracket to open up room for that long-term capital gain.
I'm telling you,
it's fun.
It's fun to you, but I'm telling you to people listening to this particular episode, and again, they're saying, "Well, gee, I just wanted to know the answer. What should I spend first?"
Well, the problem is that's the answer. The same thing we talked about last week or the week before. What's the best investment for me?
Well,
I got to know a little bit more about you so we can find out what are you trying to accomplish.
So what you're saying is you shouldn't just decide that I'm going to. I mean, even if you're going to blend all of these three things together and try to do it on your own, I honestly think that there are
there's a lot of things to consider.
Landmines in there.
We're talking about the tax code. There are landmines all through the income ranges on that. Yeah. Low income, high income, middle income. There are landmines all through there that we try not to trip. And now, taxes are a way of life, unfortunately, a fact of life. And we want to manage and be as efficient as we possibly can. But we don't want the tax tail to wag the dog. It is not the first and foremost consideration. I mean, if you've got somebody who's got 100% of their money in growth assets, and it's all personal, let's just say, and they're getting ready to retire, that they have to, in my opinion, reduce their exposure to stocks and create their bucket number one, create some safer stability assets and things.
Which is going to create capital gains.
And the risk in that respect of staying 100% stock is more detrimental than the taxes they're going to pay. They're going to pay taxes someday. They're going to have to unless they die. I mean, remember, there's only two ways to get rid of taxes.
Yes.
One is to lose the money, and the other is to die.
Right. Now, you're saying, well, the death thing,
that's not a good planning technique.
No, but you don't want to lose money because it could take a dive, and that could be worse than the tax bill that you would have paid.
Right. So you've made $100,000 on a stock, and if you sell it, you're going to pay 15% capital gain federal, sometimes zero, maybe, but let's just say 15. Yeah. But how much of taxes are you going to pay if you lose 20% on that stock? You're going to pay less in taxes, but you're still going to have a lot less left over.
Yeah, the amount of money you have left over is, And
so the risk is too much. So we can't let the tax tail wag the dog, but it is always a consideration of what we're doing when we're looking at trying to create an efficient use. Recently, I received a question from somebody that had just inherited, a little over $1 million. What are my best tax-free investment options going forward? Well, let's talk about what you need the money for, but tax-free investment options are far and few between. There's really only two that make potential sense. One would be municipal bonds, but they also said, I don't need income from this. So municipal bonds, out the window, throw those away. And the other would be some form of a life insurance program, an IUL, Indexed Universal Life, a variable universal life or something, so that we can invest it within the tax wrapper of a life insurance policy and then ultimately take money out of the life insurance tax-free via distributions of basis and loans. But is that better than paying a little capital gain tax? Well, it depends on the person.
And you got to do those calculations for them.
So we'll look at that. But if all you're doing is saying, I want my tax-free investments, this guy's going to get inundated by life insurance salespeople.
Oh,
because that's the most common tax-sensitive, free way to do things. And they do work.
But they may not be for everybody.
Right. I mean, I don't know anything about the health of this guy, for one thing.
That's true. Or it could turn out to be a very good thing.
So taxes are always a consideration because it's an expense, and we want to be really efficient with our expenses, especially the expenses we don't like. Our insurance expenses, our gas and electric. We try to be efficient with all those, putting solar or whatever the case may be, and the taxes on our distributions, income taxes. But it also doesn't mean I have people that would rather not get a return than pay some taxes.
Not get have a 0% rate of return.
Hey, I didn't have to pay any taxes. It's like, but wait a minute, let's say you had a $100,000 CD, you could have earned $5,000. Okay, so let's say you paid 40% in taxes. You still have $3,000 in your pocket versus leaving it at the bank at the 0.00 rate of return.
Yeah, it doesn't make sense to me.
But it makes them feel better because they don't pay the taxes.
Well, okay.
Yeah,
sometimes
it's their money.
Not about it's not about the numbers. Sometimes it's just about how you feel. Well, this has been enlightening, Professor Plum. As I said again, I'll say this again as we're going through all this stuff. Now I see why people wrote in and said, I'm a little confused about what you guys were talking about. Can you explain a little bit more on this blending?
And unfortunately, it's not something I can answer on the air
generically.
Yeah,
there's no answer.
Yeah, there's no take 100 minus your age to figure out how much in stocks you should have.
That's what people like, though. They want to know.
Well,
Give me the
unfortunately,
answer.
it's just not that easy.
It's not that easy, but you can talk to an advisor like you, Professor Plum. Did you say a few minutes ago it's fun?
I did say it.
Was that you who said that? It wasn't me.
It was. Well, there's only two of us in this room right
here,
now.
so by default it was you. Well, find somebody who finds it fun, such as Professor Plum, and you have been doing this kind of thing a long time. There are so many considerations here in just this one topic. Do you take the Roth? Which money do you spend first? Roth, personal, or IRA? You spend a blend of them in most cases. But how much of each is going to depend on your individual situation. Give Professor Plum a call. Any of the Lucia Capital Group advisors who work with them, 800-644-1150, 800-644-1150. They'll be able to talk to you about this. Just sit down and say, hey, look, I just need to know where I am and where I'm going. Am I doing right? And if I'm not, hey, put me on the right track based on my experience, on my current situation and my goals, risk tolerance, and all that. 800-644-1150. Don't forget LuciaCap.com. I didn't really talk. We talked a little about buckets today. This is really more of a bucket one kind of thing. How do you set up your bucket one? Because we're talking about taking income.
Well, it's the second major step in creating your bucket strategy. First is determining what investments you should have. Yeah. The second is which accounts those investments should be in.
Yeah, so you have location and allocation.
Allocation first.
First, then location.
Location second.
Yeah, and there's a big difference between those two. LuciaCap.com, LuciaCap.com. If you are still thoroughly confused, we'll be happy to. You can go ahead and email us there, by the way, at LuciaCap.com. Send us an email and say, look, would you guys just answer my particular question? We'll try our best to do that. If not on the air, then off the air. Also, don't forget I said buckets. We've got our bucket strategy guide right there at LuciaCap.com. Type in the search field, say bucket strategy, and you should see that come up as the first thing. PDF, download it, read it, and understand what we talk about when we say bucket one, bucket two, bucket three. Also, let's see. Oh, the estate planning guide. That's right. We got an estate planning guide there as well. Type in estate planning in the search bar. You'll get the same thing, except this one's about estate planning and Social Security and all that stuff. LuciaCap.com. Subscribe to our podcast, would you? That's a direct order from me and from Professor Plum. Makes us feel good when we get more subscribers. You know, every time the little bell rings and says, you got another one. Like, oh.
I don't get that bell.
Well, it's because you're not licensed like me. You don't have a Class 3 radio license like I do. That has nothing to do with it. Subscribe, Apple Podcasts, Spotify, either one, and listen to every single episode of this particular program. Hey, Professor, thank you. I hope this wasn't too complicated again, but at the same time, we can't uncomplicate something that...
There's just a lot to think about when you're playing with taxes.
It really is, and that's why I think you need the services of an advisor to help you out. We're just kind of telling you exactly how it is. I thank you.
You're welcome.
All right. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. An asset allocation strategy does not ensure profit or protect against loss. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. 401k benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider a target date fund's mutual funds, exchange-traded funds, investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Municipal bond interest may be subject to the alternative minimum tax. LPL Financial Insurance License Number 0518721. LPL-IA Insurance License Number 0B91442. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.